Savvy investors know that the use of trailing stops is an important way to ensure that they won't give back gains or incur big losses. And one of the most important features of the Exit Point website is to provide investors with an easy way to set their trailing stops and then to alert them if the stops or exit points are breached by a decline in a stock's price. Now let's take a look at a stock graph for Aflac over the course of 2012 to illustrate a point about trailing stops. And for purposes of this illustration, let's put in a 10% trailing stop and draw the line that would show where the stock price crosses that stop line to trigger a sell alert. Now as the arrow shows, the stock, which was entered into at around $45 a share, rose as high as 50 but then crossed back to 45, triggering that 10% sell alert. So while we didn't lose any money on this position, exiting right about where we entered the stock, and did actually avoid a substantial decline from $50 a share below $40 a share. That's over a 20% decline. We also lost out on the opportunity for the appreciation that occurred following, leading now to a current high price of about $55 a share. So if there is a criticism of using trailing stops as a when to sell method, it's that they can trigger a premature sell alert from a short-term downtrend that may cause you to miss out on a subsequent increase in a stock's price. The solution some investors prefer to use is to compare a stock's price movement to its moving average. A moving average is simply the average of a certain number of days closing price divided by the number of days. A moving average line drawn against the stock graph tends to smooth out the day-to-day ups and downs that you'll see from the stock price itself. Going back to our Aflac graph, we've drawn a 20-day simple moving average against the daily closing price. And you can see the smoothing that occurs. Using the 20-day moving average crossover as a guide, we see that the stock would have triggered a sell alert at around $49 a share. Not a bad gain, but still missing out on some of the appreciation to come. And if you were a long-term holder in the stock, you might be willing to take more of a risk in its price decline to share in the upside benefit. The solution is to apply a percentage trailing stop against the moving average rather than the stock price itself. Now here I've drawn a 10% trailing stop, and you can see the difference. Our stock price almost crossed below the moving average trailing stop around mid-May, but then rose consistently thereafter. Using this method, no sell alert is triggered and an investor would have continued to profit as the stock rose substantially in price thereafter. So while this isn't necessarily suited for everyone, this is a method that's very popular with some as an investment strategy. And if you're looking for an easy way to employ a strategy like this, Exit Point can help. Assigning a moving average trailing stop to a stock or other investment is very simple, as Exit Point does all the work for you. So let's take our Aflac example again, and we'll add that to our portfolio. First we put in the symbol, and we'll just pick 100 shares of Aflac. And we're going to use the price for the beginning of the year just to make this comparable to the example that we were referring to earlier. The stock price on January 3rd, the first day of trading for the year, was $44.88. And we'll ignore commission, but we'll put down the purchase date. And now here we simply look at the various strategies, and we were going to select the moving average trailing stop. And we're going to select both the percentage below the moving average that we want to employ. And for this purpose, we'll say 10%. And you see we have a selection here of both simple moving averages and exponential moving averages. We're going to select, again, consistent with the example, a 20-day simple moving average. And that's it. We're going to save this. Let me just change the account that's in. That's in our brokerage account. Save and return. Now you see the position here. And what we really want to do at this point is to determine what its exit point is based upon these particular parameters. So we click on the Calculate Exit Point button, and now we see Aflac, this second line here, and it's listing 10% below the 20-day simple moving average. Just a couple of other points to mention. You'll see in the second column to the right, Exit Point Strategy, the icon showing the moving average trailing stop. A strategy has been selected, and if you look over at the exit point column, that is the actual exit point price calculated at 10% below the 20-day moving average. Click on the icon and you'll see that the price against which it is calculated is mentioned there, 53.47. How do we get that price? Well, we can show you easily enough by looking at the moving averages for this particular stock. We're going to select the simple moving averages, and looking at AFLAC, the 20-day moving average price, there it is, 53.47 right there. Now, one important final point to note is that unlike the percentage trailing stop, which can rise in price but will never decline in price, a trailing stop on the basis of a moving average can actually fluctuate up or down, as you can see here. But if and when the stock price crosses below that moving average trailing stop, Exit Point will trigger a sell alert, advising you that it's time to look closely at the stock to determine whether it ought to be sold. Thanks for watching.